We believe infrastructure provides some good characteristics for investors, both in terms of stable, sustainable, visible long-term returns, but also exposure to some interesting growth themes over the next years and decades. Listed infrastructure allows smaller investors to access the asset class. Obviously, historically, it's a lot of large assets, large-scale investments. Through equities, investors can get exposure to those investments, those assets, those themes. And how can infrastructure be used? We think that infrastructure can be used both as a diversifier, as what might be termed an alternative asset, but also it can be used within global equity income portfolios, providing investors with some exposure to different themes, to different stocks, to what would commonly be held within funds in that sector. This is quite a new fund. It's been running for about 18 months. Performance has been reasonable. We are pretty much in line with the global equity income IA sector. And in terms of performance against peers, again, I think probably pretty much in line. There are periods where we do better, periods we do worse, but I think the key is that we're carrying on delivering our aspirations for the fund in terms of dividend yield and growth. The key for us is long-term sustainable dividend yield, well-covered dividends covered by free cash flow, but also some potential for dividend growth. An example would be a stock like Enbridge, which is a Canadian listed oil and gas infrastructure stock, a history of many years of not only paying its dividend but growing its dividend through all sorts of economic scenarios, oil price scenarios, etc. A defensive attribute to profit flows, but also potential for growth. To be absolutely frank, it's irrelevant to the themes we're investing in this fund. We're looking at stocks like utilities, like railroads, like oil and gas pipelines, communication towers. They're funded with private capital within equities, not reliant in any way on an uplift in federal or state spending. If that comes, then obviously that can benefit a number of stocks in our portfolio, but it's in no way part of our investment thesis. We have 4 UK stocks in the portfolio. We are not particularly keen on UK regulated utilities. We think the political and regulatory backdrop is not particularly supportive of equity returns. We can find better opportunities elsewhere. And indeed, 2 of our UK stocks, National Express and Vodafone, have predominantly overseas earnings. We like Vodafone. We've been adding recently. We've held Vodafone for a long time. We think there's a lot of value here. There's 2 reasons for that in a nutshell. One is the potential for mobile data growth over the next years and decades, 4G to 5G, and the fact that we believe the tone of regulation, which historically has been very much favouring low prices for customers, will switch and will begin to emphasise investment, the necessary investment in these networks, which will only come from companies like Vodafone, to make countries, cities, towns competitive in a high-speed data environment. Secondly, stock specifics. We think there's a lot of interesting things Vodafone can do. They can potentially realise the value of their towers assets. They own 50,000 European towers. They can cut costs, and actually they've got a very good position across all the markets in Europe and in India where they're invested. What we like about utilities is the visibility. When we look at US regulated utilities, because of primarily the switch in generation from coal to wind and solar and the investment that that requires, and also a lot of specific stories in terms of rebuilding pipeline networks, gas pipeline networks, investing in transmission. What we believe is we have many years and again many decades of visibility of earnings growth in utilities, particularly US utilities. We think, if we're getting something like 5 to 7% dividend growth, and we can see that potentially over the next 20 years, every year, that's an incredibly valuable theme that we can invest in.